Hi, welcome back to IFRS TV channel. Today we'll be talking about the difference between staff loan and staff advances. And the reason is because so many people get it twisted when they are testing for the accounting treatment of staff loan or staff advances. Some have it twisted by saying, oh, staff loans are not financial assets. Some even say staff advances are financial assets. So today we will learn the difference and we will see how the accounting treatment works. Okay, so let's get started. We are starting with staff loan. Here it says staff loan is a loan or salary advance given to an employee for the purpose of the employee's personal use, with an agreement to pay back the loan to the company at an interest. So what it means is that when a company gives out loan to its staff for their personal use, you will see that there is emphasis on personal use. So the fact that the company gives out cash to its staff does not necessarily mean that the company has given out a loan. So the major thing is that the staff is using that loan or that cash for personal use. So that's the major definition of staff loan, and that's what staff loan should be considered as. But don't get it twisted. It is not compulsory that a company calls it staff loan. Several companies use several names for it, but the major idea is how it is recognized, or the explanation behind it. Okay, so let's look at the other one. We mentioned staff advance. A staff advance is an expense advance given to an employee for the purpose of meeting business needs, to prevent employees from paying out of their own pocket. Yeah, so this is often what you see in consulting firms, when probably as an auditor you go to work in a client's office, and then because you are lodging in a place that is very far away from your office or from your workplace, you get an advance from your company, and then you use that advance for accommodation, for meals, for transportation, and so on. Now, the purpose of that advance is for business needs, is to meet the company's business needs. So as a result, it is not a loan. It is an advance that is given to you for the purpose of the business. And so when you look at it, you will notice that one requires that you give back cash to the company, which is what we call a staff loan. So a staff loan in essence means that by the time you get that fund from your company, you have to return it either on interest or at no interest. But we'll look at that very soon. Now, for staff advance, you are not returning cash. What you are returning is an expense, meaning that there's an expense that is being incurred as a result of you spending that money. And so for the company, it is more like they are paying for an expense. It is more like a prepaid service compared to staff loan. So if we are to look at the disparity now, we will say that a staff loan is a financial asset because what you are expecting is cash, but a staff advance is a non-financial asset. Now, for a staff loan, because the staff loan is a financial asset, oftentimes are not, it is measured at amortized cost, and because of that, you have to test for impairment. Okay, so we'll be looking at a practical scenario with respect to how to account for staff loans. So it reads here that at the beginning of the year 2022, Company A gave out $5,000 staff loan at 2% interest rate. The frequency of payment by the staff for both principal and interest is on an annual basis over 5 years, with the principal paid evenly across the 5 years, starting from the end of year 2022. The market rate for a similar loan would have been 5%. The company's year end is 31 December. So you see, with respect to preparing or accounting for staff loan, we mentioned that staff loan is a financial asset. What this implies is that it will be accounted for under the requirement of IFRS 9. And under the requirement of IFRS 9, there is the expectation that when the company is recognizing the staff loan, because it's a financial asset measured at amortized cost, you will have to measure it at the fair value. That is, you have to initially recognize for the staff loan at fair value. So regardless of the amount that the company gave out the loan to its staff, so if the company has given out $10,000 to the staff, it does not necessarily mean that that's the $10,000 that will be recognized as an asset in the books of the company. So we'll see here in this scenario how to treat that and how to account for that, because in this case you will see that there's a difference between the actual contractual rate that the company gave out to the employee, which is 2%, but the market rate is 5%, meaning that if the employee were to have obtained it in the market, the employee would have obtained it at a rate of 5%. So how do we account for such staff loan? We'll see in the next slide. Alright, so we'll be going through this file to show how the computation works for a staff loan. So remember, we mentioned that for staff loans, the expectation is that we compute the present value of the staff loan. Okay, so we have to show the present value of the staff loan as at the date of origination, because that is the requirement of IFRS 9. So quickly we'll go through the fact pattern that constitutes what we have in the staff loan. So the year end is 31 December. The origination date is 1st January 2022. The maturity date is 2026, which is in 5 years time. The loan amount is $5,000. The contractual rate in the contract is 2%, and remember the market rate is 5%. So the expectation is that by the time we discount the total cash flows, we'll be discounting using the market rate, because that is the requirement of IFRS 9. Okay, so here we have two tables. The first table talks about the schedule for the contract itself, that's how the staff is expected to make payment, while the second one is actually the IFRS 9 schedule itself, that's the expectation in terms of the recognition process. Okay, so if you look at it, we have 5 years, we have the first date, which is the origination date. Here we have the opening balance of principal, we have the principal received, then we have the closing balance. And you see that what the principal received does is it shows how the staff is paying back the loan in terms of the principal. And at the end of each year, the closing balance of the principal reduces until it nails out to 0. That is, until the staff loan extinguishes. Now the interest rate that will be received, which is the actual interest rate, is 2% of the opening balance. That's the principal. The interest received is 2% of the principal, which is the actual amount that will be paid by the staff over time. Now, to discount, remember we said that to discount we use the market rate, and what we are discounting is the total cash flows that will be received from the staff, which is both the principal and the interest. And if you look at our formula here for the first total cash flows, you will see that it is saying we are adding the principal to the interest received, and that is what is being discounted. If you see here, we are saying discount the cash flows for each period. Okay, so that is how it works. To do our discounting, if you remember our present value computation in our university days, 1 plus r raised to power minus n, which is what we have done here. So 1 plus r, the r here is the interest rate, which is 5%. You will see that if you scroll down here, it is linked to this 5% here. Okay, so raised to power. Now for each year, this is minus 1. If we go to the second year, meaning that there is a time value of 2 years, you will see that it is now 1 plus this same interest rate here raised to power minus 2, and it goes on until the end of the year, until the end of the contract term. And so it is now the present value that is added together to give us what we call the fair value of the loan. Now what this means is that the fair value of the loan is the actual amount that will be recognized as staff loan that has been given to the staff. It's funny, right? So the loan amount itself is $5,000. Quite all right. But the reason why we will be recognizing 4,598 as the company is because the interest rate is different from the market rate. So the 2% that was given by the company to the staff is different from the 5% that should have been given to the staff. What it means in essence is that the company is bearing the cost of that difference. So that difference of 402 will be like a transaction cost that will be attributed to the company. So that's how that works. Now let's look at what the IFRS 9 schedule is. So you will see that the IFRS 9 schedule is saying that our opening balance for year 2022 is the fair value of the loan. That's the opening balance. Now the interest income will now be calculated. If you look at this now, let's look at the formula. So you see that the interest income is saying take the opening balance and multiply it by what? Yes, you guessed right. Multiply it by what? The market rate. Why? Because what IFRS 9 cares about is the market rate. That's what we are concerned about. And it is this market rate that you will be that the company will be recognizing as finance income, not the actual cash received. Okay, so we will soon look at how the calculation works in terms of the adjustments to raise, the journal entries rather to raise. Okay, so if you look at what we have here, this is the actual interest. Now the difference between the interest income using market rate and the actual interest received using using the contractual rate, that difference is what gives us the transaction cost. Now if you look at the formula here, it says that the interest income plus the actual interest received will give us the transaction cost amortized. Okay, so now what will be the closing balance according to IFRS 9? Now take note of this. The closing balance according to IFRS 9 will be the opening balance plus the interest income plus the actual interest received plus the principal received. That will give us the closing balance. Now in essence, if you want to test this, it's as good as saying that the opening balance plus the interest, the principal received plus the transaction cost, that will give us 3728, because both the opening balance and the transaction cost is what the company is bearing. It is the transaction cost rather that the company is bearing, and so our closing balance for the year will be the opening balance plus the transaction cost plus the principal received, which will give us this, and it goes on and on until the end. And you see that at the end of it all, everything nils out. So this transaction cost of 402, by the time you add it together, you will see that it gives us that same difference that we have here. So basically that's how it works. And now if you want to gain access to this file, you can just go to the description box below to download it. Okay, so what are the accounting entries? As at the origination of the loan, normally you expect that when the company gives out the loan of $5,000, the company would have paid through bank most likely, and would have credited bank and then debited staff loan, because in the books of the company it is sitting as an asset. Why? Because the company is expecting that the staff will pay over a certain agreed period of time. So here it says being entry to record staff loan relates to staff. Now because the company is bearing the interest rate difference, we have to reduce that staff loan by that difference. And so what we do here is we credit staff loan to reduce staff loan, and we debit a prepayment. Now the essence of the prepayment is because IFRS 9 says that transaction cost will be amortized systematically over the period of the contract. That's why we are recognizing 402 as prepayment, and we are not taking that 402 immediately to profit or loss, because the contract is not just for 1 year, the contract is for 5 years. So what it means is that in the first year, by the end of the year, a portion of this 402 will be amortized to profit or loss, and then it keeps on amortizing until the end of the contract. So if you come here, you will see how the amortization works. So you see that in the first year you amortize 130, second year you amortize 106, and so on and so forth until you finish amortizing the whole transaction cost. So let's now look at what happens at the end of the year. So at the end of the year, there's an interest income that we recognize. Now what the interest income does is it increases the amount liable to be paid by the staff because of the delay in payment. So you see this 230, if we follow it, it is picking our IFRS 9 interest income. Okay, now remember that what is picking is the IFRS 9 interest income, not the actual interest received. Yeah, so that's why it is important for you to understand that when we are preparing an amortization schedule, it is the IFRS 9 schedule that forms the basis of our recognition in the books. Okay, so let's go back to our accounting entries. So we have established the fact that our finance income grows by 230 during the year. It grew by 230 during the year. Now back to what we said earlier about this 402. So this 402 will be amortized over 5 years. So for the first amortization, we look at what has happened during the year. So remember we said that the company is bearing the cost, so the employee cost of 130 will be debited, because what we are saying in essence is that we have borne 130 cost on behalf of our staff. So we credit that prepayment by 130. If I follow it, we see what is happening there. We are picking this 130 under transaction cost. Okay, so we'll go back. Okay, so we have said bin entry to recognize amortized portion of transaction costs recognized during the year. Okay, then the staff paid back 1,100 during the year. Now that 1,100 is made up of two things. It's made up of the actual principal received, and it's also made up of the interest received. So if we follow that, you will see that it is picking this 100 and this 1,000, which is the addition of these two. That's what it is picking. Okay, and so that is it about the adjusting entries for year 2022. So to look at the reconciliation, how does the reconciliation work? You will see that here we have an opening balance of 4598, which is that same opening balance that is our fair value, and then our interest income increased by 230. If you remember, we debited finance income by 230, we debited staff loan by 230 and credited finance income 230, and then there was a repayment of 1,100. So the closing balance is 3728, which checks with what we have as a closing balance under IFRS 9. So basically that is how it works. Okay, so let's go back to our slides. Alright, so that is it about staff loan. So let's now talk about the non-financial asset bit of it, which is the staff advances. Remember we said that staff advances are given to employees for business needs, and so what it means in essence is that the company has prepaid for an expense, because what they are expecting in return is a service, not cash. So how do we account for that? So basically, as at the point when the cash is released to the staff, what the company does is to debit a staff advance, which is an asset, at the actual amount that gave it out to the staff, and then credit bank for releasing that cash. And so after the employee has spent the cash for the business need, what happens is that as soon as the employee incurs that amount, we debit an expense and then we credit staff advance. It is not in all cases that the employee spends the whole amount. There are times when the employee actually returns part of the cash because the employee did not spend the whole amount. But the fact that the employee returns part of the cash does not necessitate the fact that it is a financial asset. Why? Because the intention of releasing that fund is actually for a service. It's just like you buying or requesting to pay for you place an order for a particular item, and then whoever is supposed to deliver it to you told you that because of some circumstances beyond my control, I can't deliver what I promised to, and as a result you request for a refund. Now when you receive that cash, were you actually happy to receive cash? Wouldn't you have preferred to have received an expense, that is to have received whatever service that you have paid for? Yeah, so that's actually how it works. Because the intention is not to receive cash, we don't take it as a financial asset. Rather, it is a prepaid expense that gets amortized based on how it is being consumed. And so that is that with respect to the difference between staff loan and staff advance. If you have enjoyed this, please make sure you subscribe, and I'll be back for more. Thank you.